Good evening, everyone. Welcome to our Irvine Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking time out of your busy schedules to join us for tonight's workshop. During our session, we really try to make these workshops very interactive, so we try to encourage questioning. So as I go through tonight's content, feel free to use the Q&A function in Zoom, and then what we'll do is we'll try to answer those questions on air so we can kind of share with the rest of the audience. So, you probably heard about this workshop because of our partnership with UCI Alumni. Really excited. I think we're probably in our fourth year of partnership with UCI, and we're really excited and proud to be a partner. We get a chance to share this workshop every couple weeks, specifically with the UCI team every quarter. So, if you enjoyed tonight's content and you want to have your friends, maybe colleagues, family check out some of these different workshops, they can always visit us on mortgageeducate.com for more of the details, and we'll talk more about that later on this evening. Just really quick about me, I'm the branch manager here with American Pacific Mortgage. Get a chance to work with our local communities on first-time homebuyers and just home ownership in general. We are specialists in first-time homebuyer assistance programs. So not only do we teach these classes, but we get a chance to facilitate financing and design different home buying plans for our home buyers. Okay, here's what tonight's content looks like. We're going to talk a little bit about the housing market and what's going on. Lots of good information, I think, to share with you as you're preparing to buy. We're going to take a look at just a rent versus buying analysis, so we can kind of do some budgeting and figure out what home buying can look like for us. We'll talk about credit and how to get our credit in a great position to be able to buy when that time comes. We'll look at student loans and how that can impact your qualifying. I know there's lots to be talked about with the forgiveness that's just been recently announced by the administration. We'll talk about loan programs and how that can help support us as a resource for home buying. We'll look at verifications of income, assets, spend some time looking at assistance programs. That's usually a pretty big hot topic with a lot of our first-time buyer classes that we teach. And then we'll wrap up tonight's discussion looking at the process of buying a house. So what does it look like to go from being, pre-approved as a home buyer to all the way to the very end of the stage of getting my keys to my home. And we'll talk a little bit about a consultation. That's where we design a home buying plan for you to get you on that path towards home ownership. Okay, so hopefully that's some great information that's going to help you on that journey towards home ownership. Now, as we're thinking about home buying, I mean, this is probably one of the biggest transactions or investments we're going to make in our financial futures. It's a lot different than running down and purchasing a car or anything like that, because buying a house is going to take, some, kind of discovery work for you in terms of, looking to make sure your credit's in position, make sure we have enough saved, making sure we understand a budget. And I think all the items that we share with you in this course tonight will hopefully help you accomplish that. And so when we're looking at budgeting and the benefits of buying a house, there's a few things to think about. With the cost of rent being as high as it is today, this allows you to create stability by being a homeowner. So being able to control kind of more of your monthly budget. This is an asset, and generally that asset will appreciate, especially like we've seen over the last 2 or 3 years. And so that creates equity. So the difference in what we owe in a house versus what we have in kind of perceived value of the property is what we call as equity. And because this is an asset, you have the ability to be able to pass along this asset to heirs of your estate. And there's still some great tax benefits that come along with owning a home. So, when we do a budget analysis, which we're going to dive into right now, we really don't want to use an apples to apples comparison, because when we look at all the great benefits that come with owning a home versus renting, it's significantly different. So let me take us through now. We're going to go into a rent versus buying calculator. And by the way, all the tools, all the resources that we discussed tonight, we're going to share back with you via email. So you'll get a copy of our deck page for tonight's presentation, as well as all the links that are in here. Okay, so let's spend some time looking at our rent versus buying calculator. And so what we're going to do is we're going to plug in a what if scenario of what it could look like if I continue to rent versus what it could look like if we decide to purchase at some point in time. Okay, so let's go ahead and again, for those of you, depending on where you're joining us for tonight's class, whether you're in Orange County, LA County, maybe you're in Northern California, I do realize some of these numbers are going to look a little bit different based upon our geography. But let's start off with a monthly rent of like $2,500 a month. Okay, and as a renter, we probably are carrying a renter's insurance policy. So we'll plug in $15 for the renter's insurance. And then usually we're going to see rental projections going up about 3% per year. Some of you may have higher rents or higher rental increases. They're going to come up based upon your next renewal of your lease agreement. And then let's look at purchase prices of homes. We're going to factor into this scenario here. We're going to look at a $550 purchase price. For those of you that are maybe in the Irvine area, maybe that's more of a condo. If you're stretching out, maybe you're in the Riverside, San Bernardino market, that could be more of a single family home. But let's just put $550 for a purchase price for tonight's discussion. And then as you're going to learn a little bit later, the minimum down payment at a $550 purchase price is 3%. And that's generally for what we call as a conventional loan, which would be a Fannie Mae or Freddie Mac loan. We're also going to include property taxes. Property taxes are generally 1.25% of your purchase price. So whatever purchase price you land on, 1.25% of the sales price divided by 12. That's how we'll factor in a monthly budget for our taxes. Homeowners insurance, that's going to cover our home for fire. Possibly you could have a flood coverage policy that would be part of your homeowner's insurance. We also want to budget in maintenance. So, when we own a home, it's going to be up to us to be able to cure whatever repairs need to be done on our house. The older home we buy, maybe the more we want to carve out for our maintenance budget. And then we want to look at this tab here, which is loan information. Okay, and so loan information we'll dig into a little bit later on tonight's discussion, but generally as a first-time buyer, we're going to be looking at a 30-year fixed mortgage. We put in an average interest rate of 5.625. We'll spend some time talking a little bit about interest rates in just a bit because there's a lot to talk about given what the changes are in the market. Origination charges, that's what your lender generally will charge you in financing. For those of you that are part of our UCI Alumni Network, we have a discount program for you, which is a $750 discount. So it allows us to reduce some of those origination charges. So you wouldn't be paying that much. You'd have $750 less that amount. And then discount points. In a rising rate environment, discount points are becoming a little bit more popular. What discount points do is they allow you to buy down your interest rate to a lower level. So if 5.625 is, let's say, a no points rate, if I wanted to pay 1 point, which is the equivalent of 1% of my loan amount, that could potentially lower that rate another 0.25%. So maybe instead of paying 5.625, maybe I'm paying 5.375% for my interest rate option. And then other settlement charges will be other closing costs, title, escrow, transfer taxes, recording fees. Those are all things that come about as part of purchasing a house. Usually we recommend that, or not recommend, but we estimate closing costs to be anywhere between 2 to 3% of your purchase price. So as we're thinking about our savings goals for home ownership, if we're going to buy a $500,000 house, 3% would be roughly about $15,000 in closing costs. And then the other assumption we want to make as we open up this tab here is appreciation rate. So as we purchase our home, hopefully over time, whatever time period that is, we're going to see appreciation. And we certainly don't want to buy a home just for the kind of the get rich, so to speak, but just the opportunity to be able to have an investment over time. We're going to assume 3% in appreciation. And then the timetable for us owning this house about 7 years. Now, of course, it'll be a little bit longer, then we can grow more in equity appreciation, but we're going to put 7 years for now. Now, the selling costs tab, what happens when we buy a house as a buyer now, when we use realtors to help us with the purchase of our home, their commissions that they earned are not paid for by us. They're actually paid for by the seller. Now, when we turn around and sell our house in 7 years from now, those same commissions that are being paid out to those agents for you purchasing the home now, you would be responsible for the commissions paid to the realtors when you eventually sell your home. And so we're gonna carve out maybe 10% of our sales price for that, and that would include other closing costs that you would have to pay as a seller. And then the last two things we want to add on is our state and federal tax rates, and then a savings rate of 1%. So that's all kind of plugged into this calculator. So when we look at our comparison, you can already see it here, but if we look at our buying versus renting over 7 years, it's going to save us about $44,000 when we factor in appreciation and tax savings over that 7 years. Now, when we look at the difference in payments, our rent's $2,500 a month versus owning probably closer to $4,300 a month. So pretty big step up from a monthly budget perspective. that's one of the things I would encourage all of you to kind of take a look at when we, leave tonight's workshop, kind of looking at different budget items that we can, or kind of look at our budget to see what's going to take for us to get to whatever purchase price we desire. But ultimately, that investment would hopefully pay off in 7 years, roughly about $44,000 through this analysis. Okay, so that's our rent versus buying tool. I would encourage you, as kind of a follow-up to tonight's class, take a look at that. I think that's super helpful for you in doing some planning for home buying. Okay, let's go ahead and get back into our slide. And now we want to kind of roll into home appreciation. I want to kind of just talk a little bit about the housing market and what's going on. So as you can imagine, with interest rates starting to rise, it's starting to change the landscape in the housing market. So when you look at this slide here, and by the way, this gray bar here represents the start of the pandemic. Okay, so we saw rapid appreciation in the housing market beginning really early Q1 2020, and we saw a really swift move upwards. And if we were to kind of push this slide out even further, looking in deeper into 22, we're probably seeing a little bit of a crest here in the market. So when we look at the previous 2 years, we saw multiple offers on homes, 20, 30 offers on a home, homes being bid up above like the asking price. So if I was asking 500,000, the house probably sold for 575 or 600,000. And that climate really made it challenging for first-time buyers to enter the market. And so now with this rising rate environment that we're seeing, we're starting to see homes stay on the market longer. We're starting to see that same house that maybe was bidding up to 575. Now it's selling for maybe the listing price. And that home where it may have sold in 1 or 2 days, now we're starting to see that sell in 2-3 weeks. Sometimes we're seeing as long as maybe a month plus. So those are all encouraging signs for first-time buyers. And I kind of shared with our workshops over the last maybe 2 months that we're probably seeing more of a softening in the market. I don't think we're seeing a correction or anything like that, or a big retraction in the market. It's more of a softening and more of a leveling to more kind of normalized levels, because this pace that we've seen the last 2 years just wasn't sustainable. And I think with the interest rate change really kind of started to give us a little bit of a leveling in the market. And what's great about that, it's allowing our first-time home buyers to enter the market, which they may have not been able to do previously. And so when we look at the market and what's causing some of maybe the slowdown a bit in the housing market, it's driven by interest rates. Average interest rate right now is about 5.66. That changes daily. And we have a big economic report coming out tomorrow with the jobs report. So we'll see what the labor markets look like and see, where our economy is at. And so based upon the data that we get from that jobs report tomorrow, it's going to move the needle on interest rates one way or the other. Generally speaking, bad economic news means improvement to interest rates. And so what we're seeing right now is a rising rate environment. And this slide really kind of encapsulates what's really going on in the housing market. So our lowest level that we saw in interest rates touched down and probably around 2.5%, 2.625, as you can see here. We kind of bottomed out in 2020. Interest rates started to edge up a little bit, and then most recently in 22, so right around the end of Q1 of 22, we really start to see interest rates rise pretty quickly. And we've seen this kind of like now really kind of choppy market, up and down, 5.6. We really haven't been under 5%, since really the probably early part of the second quarter. So interest rates, I think we're still going to stay in this, mid to high 5% level. Hopefully we don't rise any further than that. One of the questions we get probably on a daily basis is, when the Federal Reserve is announcing rate hikes, how is that going to impact future mortgage interest rates? Because we have probably another interest rate on the horizon. A lot of what you're hearing coming down the pipe for interest rate hikes is already kind of baked into some of the mortgage interest rates. The Federal Reserve interest rate uptick is not a direct correlation to mortgage interest rates. Those interest rates are going to affect more of your lines of credit, your credit cards, your auto borrowing. All that will be directly impacted by the Federal Reserve raising rates. Now, the kind of the guideline that we're looking at is we're looking at what is going on with the 10-year Treasury and ultimately kind of what's going on in the stock market. Generally, the interest rate environment will work inversely to what's going on in the stock market. So, but the stock market is impacted by interest rate volatility or movement upwards by the Federal Reserve. So we'll have to see kind of what happens as we kind of, the big spotlight is around inflation and see, what's going on there and if that's under control. At some point, hopefully we'll see a little bit of a leveling in interest rates. So, but ultimately that's kind of where we're at now. Now, as we're working with clients throughout the day and looking at different interest rate options, interest rates aren't just a one size fits all. There's a variety of different interest rates based upon your loan program, your credit eligibility, how much you finance, what your down payment is. And then you can make that decision if you want to pay additional costs or not to buy down your interest rate, which we would call points. And as you recall from our earlier conversation tonight, a point is 1% of your loan amount, or, let's say we borrow $500,000, that's $5,000 in costs that can be used to buy down that interest rate. The other thing that can impact interest rates is the term of our loan. So generally speaking, the lower my term that I'm taking in my financing, the cheaper my interest rate is going to be. So if you have a 30-year fixed mortgage at 5.66, but maybe I'm really comfortable going to a 15-year fixed mortgage, then generally that rate will be closer to the low fives on a 15-year fix because I'm taking a shorter term out for my mortgage. Now, as we're designing home buying plans for our clients, we're going to figure out what interest rates make the most sense for you. And of course, what product is the best fit given your financing goals. One of the characteristics that plays into interest rates is going to be credit. So we definitely want to spend some time talking about credit. And before I dive into credit, just want to see if we have any questions from our audience that I can take on here while we're kind of switching gears here. With any questions on the housing market or interest rates that I can help answer for everybody. Okay. All right. Well, lines are open if you do want to do that, or you have any of those questions, and we'll certainly address those if they come up later in the conversation tonight too. Okay, let's talk a little bit about credit. Credit's one of the biggest impact items for our first-time buyers. There's usually kind of two major, I wouldn't say hurdles, but they could be challenges. It could be credit, or it can just be assets. So just lack of savings for our home purchase. So when we look at credit, and there's going to be credit minimums based upon the loan program that we're going to select. So for FHA loans, the minimum score is 580. Conventional loans are 620. That's going to be for like a Fannie Mae or Freddie Mac loan. VA loans is usually a 620 minimum credit score, and those are for our veterans that have served and have the VA eligibility. And then CalHFA loans, that's our first-time buyer programs. Minimum credit score of usually 640 to 680, depending on our product selection. Okay, so that's all important things to remember. Now, what makes up FICO score? And when we look at FICO, most of you that are using monitoring services like Credit Karma, Experian, TransUnion, Equifax, those tools are fantastic. They are giving you a credit card score, so it's going to look a little bit different than the mortgage score that we get. And there's a weighting to FICO score calculation. So when we look at that, here's what the weighting looks like. So 15% of our FICO score is how long I've had credit. 20% is going to be how long or how much credit I have in use and how much credit I'm trying to access. Now, your length of credit, just to take a step back for a second, length of credit is going to, what it says is the longer my credit file is, the better I'm going to have in credit score. So if I have a new credit, but I paid on-time credit, as I continue to grow my credit file, the more mature my credit profile is, the higher my credit score should generally go. With credit and new credit we're trying to access, if I've established a lot of new accounts, that's going to hurt my credit score. And then if I have inquiries, specifically hard inquiries, that can hurt my score as well. That's 20% of the weighting. As we start our process, we start with a soft credit inquiry, which actually doesn't impact your score. It just gives us visibility to your credit score. Now, eventually, when you decide to purchase a home and you have an accepted offer with the seller, then we're going to do a hard inquiry. But initially, we only start with a soft credit score. The other 30% is going to be how much I owe. That's also known as credit utilization. So if we take our credit limits versus our credit balances, then that is going to be for utilization. So if I have $10,000 in credit limits and $5,000 in credit balance, my credit utilization is 50%. Okay, so we had a question that came in on the credit side, which is, what about using FICO score directly from a bank? Like if I get it from like Bank of America, is that the only factoring my credit card I have with them? So Bay of A, Wells Fargo, who I bank with, any of your different financial services will offer you to get access to your credit score. And yes, they are only using the credit card score, so it's not going to be a good representation of what your mortgage qualifying can look like. You would want a mortgage lender to take a look at that for you. Now, I subscribe to a few different tools. Experian is one of them. And I think I like Experian because you can upgrade your service and also get all three all three credit models. There's the mortgage model, credit card, of course, which we've talked about, and there's also the auto model. So we can, having the access to that can give you a good sense of if you're going to apply for a car loan or a mortgage, you kind of have a good idea of what your score looks like. Okay, the last component to FICO score is going to be payment history. So the better I paid my payment history, obviously the better score I'm going to have. Payment history is rated by 30-day lates, 60-day lates, and 90+ day lates. Now, if I've had lates in the last 12 to 24 months, those are going to be the most impactful to my score. So as I move further away from that date of the last event, then I should see my credit score start to grow. Okay, so that's what's built in the FICO score calculation. Now, other factors like bankruptcy, short sales, collections, we talked about a little about late payments. Those are going to all have an impact to your credit score. I'm going to show you a matrix that kind of gives you timelines on how long that stuff will stay on your credit report. Let's talk a little bit about how to manage credit utilization, because that's probably one of the biggest impacts to credit score. Because most of our clients are making on-time payments, but maybe their score hasn't really optimized, and generally it's because of utilization. So a rule of thumb is you want to try to pay down your credit balances before your billing cycle date, because at the end of your billing cycle date is when your credit card issuer sends out the data to the credit bureaus. So even if I'm still paying off my bill by the due date or paying it down, it's kind of too late by that time, because at the end of your billing cycle date is when the data has already been sent off to the bureaus. So if you can kind of take some time, and maybe this is one of your to-dos after tonight's class, take a look at your billing cycle date. And if you can kind of change your payment behaviors to pay off or pay down before the end of the cycle date, that'll help give you a better credit utilization for your FICO score. Account closure is pretty important too. So you want to really try not to close out revolving accounts, because when you do that, that eliminates all that great history from your credit score. So, and that obviously would impact the length of credit that you've had. Final thing to touch on here on the credit slide is for financing like mortgage financing, we're always going to look at the middle score for a borrower out of the three bureaus. So there's three agencies that report: TransUnion, Experian, and Equifax. And so if I have a top tier score of 740, but my middle score is 720 and my lowest score is 700, we're going to take the 720 score to determine my qualifying, even my interest rate options. Now, if I'm going to apply jointly with my partner, and my partner's at 700, 680, and 660, my partner has the lowest middle score of 680. So that's the score actually we're going to use for qualifying purposes. So that's just important to know if you're going to apply jointly with another applicant. Here's that matrix I mentioned to you that kind of shows you how long negative items will stay on your credit. So credit hard inquiries are going to be with you for at least 2 years. Generally, the last 6 to 12 months of inquiries are going to be the most impactful to your score. Late payments will be on your credit report for 7 years, but as you get further away from that date of that last event, it should start to improve. And then you can see the bankruptcies, federal student loans, like any federal debt generally will be on your credit report indefinitely. Let's talk a little bit about student loans. I know there's a lot of headlines with forgivable or forgiveness in student loans, and that varies based upon your income levels. Now, while that's kind of making its way through Congress and getting signed off, or maybe actually already been signed off, but as the implementation comes, we still, as lenders, if your student loan is still reporting with a certain balance, we still have to factor in a monthly payment for you with qualifying, even if you're in forbearance right now. That also includes our clients that are back in school, or maybe working on their graduate degree, whatever the case may be. If those student loans are not in an active repayment, we still have to count a monthly payment for qualifying. Usually if you're on an income-based repayment amount, and so we have an example here. So if I have like $75,000 in debt and on an income-based repayment amount that's, let's say, $250 per month, that's the amount that I'm going to use for qualifying. Now, we're going to talk about programs in just a bit, but for FHA loans, the standard is to use 0.5% of our balance if I'm not on an income-based repayment amount. And then for conventional loans, the default is 1%. Again, if I'm not on an income-based repayment amount. You can, in some cases, be at a zero payment. And if that's what you've signed up for on your income-based repayment, then that's what we could use to qualify you for financing. But student loans is generally something that's going to come up as part of a consultation. So we'll kind of sit down with you and talk a little bit about what those monthly payments look like and how it can impact your overall qualifying. Okay, we can always go back a little bit and talk about student loans if you do have specific questions. I think, again, in terms of the forgiveness portion of your student loans that we're going to see coming down the pipeline, as those balances are reduced down, those balances will have to be updated, of course, on the credit bureaus, and then as a lender, we'll be able to factor that into the overall qualifying. But feel free to send me a question if you have any more questions on that. Let's talk a little bit about loan programs. These are the 5 kind of core programs that we look at in financing. Conventional loans, which have a minimum down payment of 3%, FHA loans, which are a minimum of 3.5%. And then we have our VA loans for our veterans. They can also be first-time buyers or second or third-time buyers. USDA, that's going to be for more of our rural areas. So for those of us who are in Southern California, it's going to be more of our desert city areas. For an LA County, kind of pushing up a little further north beyond the edges of LA County. And then we have jumbo loans, and jumbo loans are generally going to be for our first-time buyers, but that doesn't mean that first-time buyers aren't eligible for these programs. It's just going to require a little bit of a larger down payment. Usually we'll see jumbo loans once we go beyond a loan amount of $970,800, which is the conforming limit. Those down payments are usually 10 to 15%. Okay. Really quick, I had a question that came in on student loans, so we want to backtrack a little bit. The question is, can the mortgage lenders see what I pay on my IBR or IDR payment when they pull a report, or will I need to provide that documentation? Good question. So most times lenders will not see that IBR or IDR payment on your credit report, because right now, because the accounts are in forbearance, they show as zero. Sometimes some of the private student loans will show as a minimum payment. What I've seen, and I look at hundreds of credit reports, it's usually going to show as zero right now. Okay, good question. Okay, so going back to jumbo loans, 10 to 15% down minimum down payment for jumbo loans if we finance more than $970,800. Now, there's a little bit of a caveat to the jumbo product that doesn't exist with some of the other programs we're going to talk about, which is what we call as reserves. And those are additional assets that we're going to need to have left behind after we've contributed our minimum down payment of, let's say, 10 to 15%, closing costs, which we learned are anywhere between 2 to 3% of our sales price. And the reserves will usually be anywhere between 12 to 18 months, the equivalent of our monthly payment. So if I have a mortgage payment of $6,000 a month on a jumbo loan, and I have a 12-month reserve requirement, that means I need to have at least $72,000 in additional assets beyond my down payment and my closing costs. Now, that can take different forms like 401ks, 403bs, brokerage accounts. So that's all allowed, but it will be a little bit more of a significant asset requirement for those type of products. Now, let's talk a little bit about conventional loans and FHA loans, because I would say for 95% of our first-time buyers, that's usually the product sets that we're going to look at. So conventional loans have a minimum down payment of 3%. Now, that goes all the way up to amount financed of $647,200. So that's going to be the case. Now, if we're joining us from San Bernardino County or Riverside County, those loan limits go only up to $647,200. So we can't go any more beyond that. Now, if you're joining us from LA and Orange County, we can go up to a full loan amount of $970,800. However, once you go beyond a loan amount of $647,200, that minimum down payment jumps from 3% to 5%. So that's because the conforming limit is $647,200. But when we go in the high cost of living areas like LA and Orange County, you can go higher with Fannie Mae loans, but it just turns into a high balance loan. And that's why that down payment amount increases. Now, the other product that we do a lot of for our first-time buyers, and it's not just for first-time buyers, but it's called an FHA loan. So Federal Housing Administration, minimum down payment of 3.5%. If you're in, again, San Bernardino, Riverside County, that goes up to $647,200. For LA, Orange County, you can go up to $978,800, but we don't have that high balance restriction of the $647,200. You have a full 3.5% down payment on FHA. Now we're going to talk a little bit about private mortgage insurance, also known as PMI, and that comes into play when we put less than 20% down. And we have, I think, which is a pretty helpful slide here to show you what PMI looks like and kind of the different options available through PMI. Because, it's always our goal to put as much money down as possible, but, it's not always achievable for all of our buyers. Now, I'm going to talk a little bit about conventional mortgage insurance, and then we'll switch gears and talk about FHA mortgage insurance. Conventional mortgage insurance gives you a few different payment options. So you can pay it monthly through your mortgage payment. You can also split it up between having a little bit paid monthly and have some of it paid up front. You can pay all of it up front. That's called the single premium. And then you can also add lender paid mortgage insurance to increase your interest rate and buy out the mortgage insurance. So let's say I have a 5.625 interest rate, but I really want to buy out my mortgage insurance. Maybe I select a 6.125% interest rate to buy out that mortgage insurance. That's called lender paid mortgage insurance. Most times our clients are going to elect monthly mortgage insurance because it just makes it more affordable. And mortgage insurance on a conventional loan has a cancellation option. So usually when you have at least 2 years in your loan and 20 to 22% equity, you can apply to have the mortgage insurance canceled. Now, in a rising rate environment like this, in some cases, buyers down the road in 2 years may not necessarily need to cancel their mortgage insurance. When they have enough equity, maybe they decide to refinance because rates are slightly lower, and that's totally an option, whether you're doing a conventional loan or an FHA loan. Private mortgage insurance on a conventional loan is based upon three things. It's credit score, it's your down payment, and then how much you finance. So based upon those factors, you're going to pay a premium for your mortgage insurance. Now, for those of you that are already doing searches on Zillow or Redfin and doing some, payment analysis off that, a lot of those calculators are not as granular in terms of the calculations. So you're probably going to get a much higher payment than using maybe a calculator through our mobile app that we offer, which we'll talk about a little bit about later, because it doesn't have those components built into it with credit score, down payment, and amount finance. So if we looked at a conventional PMI example down here, a loan amount of $450, and let's assume I have a 740 credit score and I want to put 3% down, the PMI is actually only 183.75. So it's a lot less than probably what you see on some of your online calculators. And it does have potentially the cancellation option. So that's a great thing to see with conventional. And then if I put even more money down, that PMI will obviously go down as I'm able to increase my down payment. FHA loans, it's a little bit different. FHA has that minimum of 3.5% down. However, with FHA loans, we have a minimum 0.85% factor on MI, which basically means if I take my loan amount times 0.85%, divide that by 12, I come up with a monthly figure. And you can see that figure down here at the bottom, which is $324.32, assuming a loan amount of $450. So that's what I'm going to pay regardless if I'm a 620 score or I'm a 720 credit score. So that doesn't change with FHA. And it also has what we call upfront mortgage insurance. And it's 1.75% of your loan amount. So in the same scenario would be $78.75. That gets added into my amount finance. And that's standard whether I put 20% down or 3.5% down with FHA. Now, if you put at least 10% down on FHA, the mortgage factor goes to 0.80, but still, it's still going to require mortgage insurance regardless of the amount of down payment. Different than conventional loans. So the other thing that we want to look at with FHA or be mindful of is that it doesn't have a cancellation option. So the only way we can get rid of mortgage insurance is if we refinance out of FHA. So as you're looking at kind of a product comparison side by side, you may ask yourself, why would I include or why would I even consider FHA given those factors? And, everybody's financial situation is a little bit different. FHA has a little more leniency from a guidelines perspective, lower credit score requirements. Some of the seasoning periods with credit lates or foreclosures, bankruptcies, short sales All those are a lot less time frame, a lot less of a timeline than say a conventional loan. Here's an example. So if I had a bankruptcy that was 2 years ago, FHA would allow me to be financed. However, if I went to conventional would want me to have 4 years since my discharge date of my bankruptcy. Same thing would hold true with like a foreclosure. So if I had a foreclosure 4 years ago with FHA, no big deal. Conventional loan, I would want to have at least 7 years out of my foreclosure. So those factors may have a client look at maybe FHA over conventional, but everyone's situation is a little bit different. So we encourage clients as we go through a consultation, we're going to look at some different product options and see what the best match is for you. Okay. So we're going to kind of switch gears now. We're going to go away from product now. We're going to talk a little bit more about the documentation required as we kind of pursue homeownership and talk about some different employment scenarios that hopefully will be helpful for you. So as a W-2 wage earner, usually we're going to need the last 2 years of W-2s, last 30 days of pay stubs, and then we're going to verify your employment. Now, as a wage earner, we usually want to see at least 2 years of employment history and or a combination of education. So if I just graduated from UCI, let's say this spring, but I just started my job, I clearly don't have 2 years of work history, but if I can show that I have education in my field or my field of study, then if I can show, like, let's say, for example, I have a 4-year accounting degree from UCI, and now I'm working for an accounting firm, that all syncs up to at least have my 2 years. That I could still be qualified for a mortgage because I can show my full 2-year history and or education. You don't necessarily have to have 2 years on the same job. I think that gets miscommunicated a bit too. So you can be starting a new job, even have like an offer letter for your next employment, and that new pay amount can be used for qualifying purposes. And then another thing that comes up quite a bit is part-time work or dual employment. So if you're in maybe a part-time position right now that's less than a full-time schedule, we have to show 2 years at that one employer if it's part-time. If we're in a dual employment situation, so let's say I'm working 30 hours with one employer, 20 hours with another, in order to count both sources of income, I do have to have a consistent 2 years at both employments. So that's where it gets a little bit tricky if you're trying to use multiple sources of W-2 employment. If you're self-employed, you have to generally have at least 2 years self-employment history. So even if you're a W-2 wage earner and you maybe drive for Uber on the side, and you also want to count that income, as long as you were driving for Uber consistently for 2 years and doing your full-time job, then we can count both sources of income. When you're self-employed, we'll usually want to see the last 2 years of taxes. And that also include like a profit and loss statement, maybe a balance sheet. And then we have to verify the business through some type of records, whether online verification, business license, maybe even a CPA letter. So it's a little more complicated for self-employed individuals, and depending on your tax structure, we will ask for certain pieces of documentation. Okay, any questions about qualifying income, some of the documentation needed, maybe some scenarios, because that tends to come up in our workshops. Want to make sure I answer any questions that are out there. Okay, we're going to stay with income a little bit longer. So if you do have some questions on employment scenarios, feel free to let me know. One thing actually that comes up, I'll just share this with the group, is that obviously employment changed for many of us during the pandemic, especially, at the height of pandemic, and layoffs happened and all that stuff. So the question we get often is, if I wasn't employed in 2020 or even 2021, I just went back to work, can my new income be included for my qualifying? The answer is yes. As long as it's full-time employment, we can verify hours. That income can be used for qualifying purposes. Okay, so speaking of qualifying, one of the things we look at in designing a home buying plan for you is a calculation called debt to income ratio. Many of you are probably even familiar with it. It's a real simple calculation. It takes your gross monthly income versus your obligations, and then we get a percentage. Usually we don't want your gross monthly income to consume more than 43 to 45% of your your obligations to consume more than 43 to 45% of your pre-tax income. That's a pretty generous calculation because obviously, our net income looks a little bit different than our gross monthly income. So when we look at that, we want to make sure we're really careful in designing a plan for you. And so a conversation that we're going to have as part of your consultation is just to see kind of where your budget needs to be. Most of our first-time home buyers feel really good around a 33 to 36% debt to income ratio. Here's kind of what the calculation looks like. We're going to factor in our principal, our interest, our property taxes, our homeowners insurance, and the HOA expenses if I'm buying maybe a condo or a townhouse. And we want to take that plus our monthly obligations we have like credit cards, car loans, and divide that by our monthly income. And that comes up with a debt to income ratio. It's in some cases we can go as high as 45 to 49%. I mean, there is a little bit of wiggle room, but generally, it's going to be in that 43 to 45% range. Okay, question came in about documentation, so we'll take a step back for a second. One of our audience members just wanted to confirm the documentation for a married couple. And that's a good question. So the question is, if we're a married couple, what documentation is required for both partners? So it really just depends on how you apply for your mortgage. So if you apply, let's say if I apply individually and I'm married, doesn't mean I have to have my spouse's documentation submitted to the lender. If I submit an application jointly with myself and my spouse, then I would have to submit documentation for the two of us. Okay, so we have a lot of clients, and we're going to talk about first-time buyer programs in just a second, because at times, especially given the income limits for some of the first-time buyer programs, some married couples will want to just apply individually so they can try to maximize the benefits, and that's certainly something that's allowed through first-time buyer programs. Okay. Good question. And we can touch on that a little bit further when we go into our first-time buyer programs. Let's talk a little bit about assets and the savings that we're going to need and documentation required for that. So as we've learned earlier, we're going to have to save for our down payment, and we're going to have to save for closing costs. And then if we're looking at jumbo loans, we obviously have the reserves for additional assets. So we all know all that. Now, that being said, let's talk about how a lender is going to document things. Checking and savings accounts, we're going to need the last 2 months of those statements generally. Cash deposits are not acceptable. So in fact, I was having this conversation earlier with the client. So even if we have cash sitting around that maybe our family is provided to us, or we've just saved because we didn't want to put it in the bank account, that cash cannot be used in a real estate transaction. So everything has to be paper trailed in the process. Large deposits, like let's say I just got a gift from a family member, those have to be all sourced back. Gifts are allowed to be used from a family member, but they just have to be sourced. Retirement accounts can be used, 401ks, 403bs, even IRAs. Usually with 401ks and 403bs, you're going to borrow against those, so that's totally fine. No tax implication there. IRAs, you want to check with your financial or tax advisor to make sure you're doing the right thing from a tax perspective. And then gift funds can certainly be allowed, especially for our first-time home buyers. If you have family that's looking to help you out for your down payment, maybe your closing costs, usually the documentation required is a gift letter. If the donor has already transferred you the money, then we'll have to document where that asset was used from the donor, and then just kind of receipt of the wire or how those funds were received by you. But gift funds are completely allowed. It's different than other assets because most assets require a 60-day seasoning time. Gifts don't. They can be immediately sent over and can be used right away for financing. Okay. All right, so that's a little bit about assets. If you heard me speak about our 2 challenges earlier in home purchasing for first-time buyers, like we said, it's usually credit if we have to work on the credit plan, or it's just lack of resources for down payment. And we have a great tools and resources available to you to help kind of overcome that obstacle of just having enough savings, because that's really probably one of the biggest challenges is just I'm just trying to get my financial future on track, and I just don't have enough money. But with the cost of renting, I would love to buy, but I just can't. And so we partner with CalHFA, which is the California Housing Finance Agency. It's designed to help low and moderate income households achieve homeownership and sustainable homeownership. And there's a variety of different programs that are available. And so I want to touch on a few of those tonight in our workshop, and going to give you a little bit of a preview of other programs that are coming down in the hopefully next 3 to 6 months. The first program that you may have even seen broadcast in the news, I know KTLA was doing a spotlight on it up in LA. And we've seen a lot of activity in this in the Bay Area markets too, but it's called the Forgivable Equity Builder Loan. What's really cool about this program, it provides up to 10% of the purchase price in forgivable assistance. And so as long as you stay in the property for 5 years, you would get, let's say if I bought a $500,000 house, I would get $50,000 in assistance that is completely forgivable as long as I occupy my home for the next 5 years. And that really changes the game for a lot of first-time buyers. So instead of having to just put the minimum of 3%, now I can put 10% down and hopefully make my payments a lot more affordable. Now you have to be less than 80% of the median income. For those of us in LA and Orange County, it's less than $78,320. So, it's not going to allow us to purchase, a large sales price of home, but you can add on additional funds. So if you have family that's willing to help out, you can add on top of that 10% down. So if you have a family member that's willing to match, or you have 10% down saved, and then you want to use the 10% down equity builder, that could allow us to put 20% down on a house. So can be a really awesome opportunity for us. It cannot be combined with the My Home or the ZIP program, which we're going to talk about in just a second. It's kind of a self-standing product. So, to be able to use the product, it would just be that 10%, which is still a tremendous amount of funds available for your home purchase. So that's designed to help low-income housing. And by the way, depending on if you're joining us from the Bay Area, Central Valley, Sacramento markets, the income limits change by county. And so as we go into other high cost of living areas, the income limits will change. So if you happen to be joining us from, let's say, Alameda right now, the income limit in Alameda is like 120,000. So it looks a little bit different based upon where you're looking to purchase. Okay, so that's designed to help low-income housing households. The other program is our moderate income product, and that's through CalHFA as well. And there's two different product designs. There's the My Home Assistance Program. It's going to provide up to 3% in assistance to help fulfill a conventional loan, or 3.5% for an FHA loan. Now, the difference with this and the Forgivable Equity Program, it's a low-interest loan at 1%. And it's not required to be paid back until I either sell the home or if I decide to refinance my home in the future. So it's a really awesome opportunity to fulfill all of the down payment that's needed to home buy. And now you can also add on what we call the ZIP Assistance Program, and that is for closing costs. You got to start with the My Home program first, and once you fulfill the requirements for that, then you can kind of add on the ZIP Assistance. That is anywhere between 2 to 3% of our loan amount in zero interest assistance. Now, right now in today's market, because interest rates are really super volatile, the 3% ZIP really isn't available because of interest rates moving up so fast. The 2% of ZIP is available, but it doesn't always make as much sense for our clients. And so that's something we can certainly talk through as a part of a consultation. A My Home Assistance can fulfill the down payment, but more than likely, you're going to have to probably save at least the closing costs for those out-of-pocket expenses. But I think the My Home Assistance can still be an awesome complement for your first-time home buying experience. Now, these income limits are much more generous on the moderate income product. As you can see here, they go up quite a bit for moderate income. So 235 for Orange, LA's 180, and then of course you can see the surrounding counties. So moderate income, much more lenient. Most first-time buyer programs, especially in the Southern California markets, are going to be capped at that $78,000 level. So this is a great opportunity to create an entry point for yourselves into the housing market. Let me show you a scenario on the CalHFA conventional loan for moderate income households. So if I bought it $500,000, the minimum down payment would be 3% or $15,000. So the My Home Assistance is going to help fulfill that amount of money. But then we also have closing costs. And I mentioned earlier that's anywhere between 2 to 3% of our purchase price. So that's another 10 to 15,000. So theoretically, if I just use the My Home Assistance and I could somehow save anywhere between $10,000 to $15,000, then I would have enough funds available to purchase my home. Now, the difference being is if I didn't utilize an assistance program, maybe I would need $25,000 to $30,000 in funds out of pocket. So adding that My Home Assistance really helps to lower or decrease the amount of out of pocket. And then, of course, as I mentioned earlier, there's the ZIP Assistance. But really, for right now in today's market, the 2% ZIP is what would be available. We would have to look at and see if that makes the most sense for you as a first-time home buyer. But hopefully the takeaway here is there's definitely some resources that are available to you as a first-time home buyer. The same assistance applies for an FHA loan. So if that's a better financial fit for you, the FHA program can work as well. Now, there is some eligibility requirements for this. As we learned earlier, there is credit score minimums, 640 for the FHA product on the moderate income product, 680 for a CalHFA conventional loan. And let me just, as a side note, when we utilize CalHFA and if we're doing conventional financing, it's truly a conventional loan. So it's not an FHA loan. So that's really important to know, because I think a lot of people get the acronyms mixed up. They think FHA is really HFA and vice versa. So, but CalHFA is strictly just an assistance program, California Housing Finance Agency, and then you have the opportunity to elect a conventional loan or an FHA loan with that program guidelines. The debt to income ratio that we learned about earlier is maximum of 45% for this program. And a question came up earlier about documentation. And so that's where I think this kind of dovetails in really nicely to income qualifications, because with this program, we only look at the applicant's income. So if I'm a married individual and I'm only applying in my name, my income is the only thing that's going to be utilized for the qualifying of the income limits. And I think that's especially important, especially on the equity builder program. So, if I have combined income of $100,000, but I only make $70,000 and my spouse makes $30,000, then I could potentially be eligible for the equity builder program. Same thing holds true for the moderate income product. So if I make, $100,000 and my spouse makes $175,000, if I apply just in my name, then I could potentially be eligible on the moderate income product. So there's a lot of great ways that we can kind of customize financing on the assistance programs. Now, a first-time buyer is someone that hasn't owned in the last 3 years. Okay, so if you owned back in 2010 and have since sold, as long as you've rented for the last 3 years, you're still considered a first-time buyer. And eligible properties include single-family homes, condos, townhouses, even manufactured homes. It cannot be in a park, though. It's going to have to be on land that you actually own. So you can't construct like a property and bring it in, anything like that. And below market, or we also call them BMR properties, are also eligible for these programs. Okay, we had a question that came in. I want to give you okay, you are welcome. So there's a program coming out, and you're our first workshop that we're kind of giving a glimpse into this program, because I get a chance to work directly with CalHFA, and I think this is pretty exciting. We don't know the launch date, but it's called the California Dream for All, and it's already passed through the state Senate. And what that program is doing, again, called the California Dream for All program, and it's allowing moderate income buyers to be able to get assistance of up to 20% of their sales price in a no interest loan. Now, that loan is not forgivable. It's paid upon the sell or refinance of your home, but it's providing 20% assistance. Now, it has that component to it, and the details are still yet to come down out to the communities. But the other component is it has an equity share agreement, which basically means as my home grows in value, I could potentially be paying back to the state 20% of my equity appreciation. So let's say my house grows by $100,000 in equity. I would have to pay back 20% of my proceeds back to the state on top of that 20% that I'm receiving through the no interest loan. So it's a great opportunity to help now our moderate income households, because a lot of our clients that would really love to buy, but maybe make more than the low income threshold, can now get that assistance to buy in some of our high cost of living markets, Orange County, LA County, all of our counties up, especially in the Bay Area markets too. So that's called, again, the California Dream for All product. I would encourage you to maybe subscribe to some of our social channels on Instagram and Facebook, because we're going to start posting updates as we hear more from the state. Currently, right now, it's in product development, but I wanted to share that with our audience tonight. And then certainly for our clients, we'll be sending out email updates as well. So really cool product forthcoming. And that's kind of all the details that we have at this point. So. All right, so that was the California Housing Finance Agency first-time buyer programs, and we can talk more about those during a consultation for you. So now let's look at the process of buying a house and what it looks like. So we're going to take you through our 6 steps of home buying. The first step on this journey towards home ownership is going to be pre-approval. And pre-approval is the output of a consultation. So consultations when you do a one-on-one with us and get a chance to design a home buying plan. And I'll kind of show you more of the framework in just a second. But a pre-approval is a certificate that you use to present with your offer. Usually that pre-approval certificate is good for 60 days. And if it takes you longer to find your home, we can always recertify a pre-approval, not a big deal. We have clients that have been shopping for the last year or 2 years. And so obviously with the market changing quite a bit, we're starting to update more pre-approvals. So pre-approval is going to be the output of a consultation. Step 2 is going to be house hunting. So that's when you get a chance to partner with a realtor and get a chance to look at different homes that, fit your budget. And, whether your search starts online or you just start to hop in the car and go look at homes or attend an open house, you can completely do that now knowing that you're fully qualified. We really encourage clients to get pre-approved first versus trying to find the house and then figuring out how to make the financing work. I think it's a lot better when you have a budget and then you start the home search. And then our pre-approval letters can always be matched up to, adjusted to match your purchase price. So that can easily be done. We really try to stay connected with our clients, whether over email or phone or just messaging, just to make sure that you're getting all the information that you need during the home buying process. Now, if I present an offer to a seller, maybe my realtor presents the offer to a seller and the seller accepts my offer, then we do go to the next milestone. That's called entering escrow. So that means the seller has accepted our offer. We've agreed to terms of the contract, and now we've begun the escrow process. Usually the escrow process takes 25 to 30 days. And usually it's more kind of on the 30-day side. Within 2 to 3 days of our acceptance, we'll be asked to do what we call an earnest money deposit. I have a slide that we'll show you in just a second that kind of highlights what an earnest money deposit is, but it's ultimately 1 to 2% of your purchase price that counts towards your down payment and closing costs. And then within 24 hours of your accepted offer, our team's going to reach out to you to schedule your follow-up consultation. And that's where we meet with you over video to review your contract, timelines, interest rates, and all the different product options that are available to you, and just kind of design your financing so you feel comfortable with what your financing looks like for you. Your realtor will help order inspections. We will order an appraisal of your property because we want to make sure your house is worth what you're buying it for. And then within 72 hours of that consultation, you're going to get what we call your initial disclosures that highlight your product selection, your interest rate, and your out-of-pocket expense. Now, earnest money deposit is 1 to 2% of your purchase price. That's going to be required to be deposited into escrow within probably 2 to 3 days of your contract. Some markets, like the Bay Area, for example, has a slightly higher average percentage of earnest money deposit. It can be as high as 3%. At the end of the day, that money still will count towards your total out-of-pocket expense. And those funds are held with the escrow company because you do have what we call as a contingency period. And it's a timeline that stretches from anywhere from day 1 of contract up to 14 to 17 days from day 1 that allows you to do your homework on the property. And that homework includes getting the house appraised, which I mentioned earlier, getting your house inspected. The realtor will generally organize that for you, and then getting your loan approved. And we want to make sure we have those contingencies in place because that helps protect you as a buyer, that your deposit can't be released to the seller until the close of escrow, when you've released your contingency and given them the okay that you've done all your due diligence and you feel really comfortable about this property. Okay, from step 3, it's going to move us to step 4, which is processing and underwriting. And that allows our team to verify your income, your assets. We're probably going to verify your employment. By that time, your interest rate has been locked in. And that's something we talk about during our consultations with you at the origination of your loan. And then we will submit your loan over to our underwriting team after we have all of our documentation. And that submission to underwriting will take us to step 5, which is your loan approval. And that's when our underwriters have reviewed all those income documents, your product type, determine that you fit all the eligibility criteria for the program, and issue that loan approval. It also takes us to the end of your contingency period. So if you feel comfortable with your inspections, your appraisal comes back okay, and you have loan approval, then you're probably going to go ahead and release the sign off on your contingency. Now, it's important to note that once you release your contingency, then you're telling the seller that you're comfortable in moving forward in the process. So if you maybe change your mind a couple of days later, you could risk losing your deposit. So we really want to make sure this is the house for us before we make that sign off on the contingency. At step 5, as a lender, we're going to issue to you a final closing disclosure. And that's going to give you a 3-day cooling off period to make sure that all the disclosures match up to what you expected. And after that 3-day cooling off period has elapsed, then we're going to move to step 6, and that's called closing your loan. That's where you as a buyer get a chance to sit down with a public notary and sign final documents for your loan. That process will take maybe about an hour to hour and a half, maybe a little bit longer, depending on what assistance programs you have. After you've completed that signing, then you're going to go ahead and wire in or get a cashier's check for the remaining amount that you owe for closing. Those funds will be receipted in by the escrow team. And then behind the scenes on the lending side, we're going to do a final audit of all the numbers, make sure everything is accurate, make sure you've signed everything properly. And once that's completed, we'll wire in the funds for your mortgage and any assistance programs you've elected. The escrow team will reconcile those funds, make sure that you've contributed what you should as a buyer. And if everything looks good, then they'll go ahead and release the documents to the county recorder's office. And the county recorder will record a grant deed, and that transfers ownership to you. And they also record a deed of trust. And once the escrow team gets recording confirmation, then you become the official owner of the property. And that's your 6 steps of home buying. So that kind of walks you through everything that you'll experience in the home buying. And, part of that process, we're going to be a little nervous, a little anxious, a little stressed out of all the things that are moving, because there's a lot of moving parts involved in the transaction. But our job is to help you kind of navigate those waters and get to a successful finish and get a chance to celebrate, the huge accomplishment of homeownership. But first, it does start with a consultation where we design a home buying plan for you. And I really encourage you, attending tonight's workshop, if you want to meet up with us one-on-one to design that home buying plan. We'd love to be able to connect with you. Here's all the information to get connected with us. We have our Get Started email that we can send you that has our online application link, a list of documents, and then we would generally get together for like a video consultation. If you have some questions after tonight's session and you just want to kind of just touch base to kind of review a scenario, whether it's documentation or credit, you can always schedule an intro call with us. Here's all of our scheduling links right here, so feel free to take a look at those as you get the presentation material. I promised you I'd share with you the kind of the framework of a consultation. Here's what it looks like. We're going to go over a budget analysis. We'll talk about like kind of location of where you're going to buy, because obviously price of the home will vary based upon where you want to buy in California. What some of those markets look like. We'll look at interest rates, closing costs. We'll do your debt to income ratio analysis. And we'll kind of really design that plan. So by the time we leave that session, you have a comprehensive home buying plan. And if you're ready to start that journey, we'll send out a pre-approval, and then you can move into step 2 of the process. Here's a great resource. I think I mentioned it earlier. This is our mobile app. You can start the application process right through mobile. You can follow the progress of your loan, chat with us all over mobile. I think it's a great tool to start your journey towards homeownership. And many of you had joined tonight's class because you heard about us through our UCI Alumni Partnership. Really excited to partner with not only UCI alumni, but all of our fantastic schools that we partnership. In fact, we just launched a new partnership with Sacramento State here in the Sacramento markets. And we have many other schools that we're looking to join with and just kind of share all the great tools and resources and really try to educate more of our community on first-time homeownership, especially in these kind of challenging times financially that we're all going through. I think everybody that can get more information and have more resources to have a plan for their finances, I think is super valuable. As I mentioned earlier, we have a discount for our participating alumni. It's a $750 discount on our closing costs. Our consultations are a free service we provide, and we just put free there because many people think we charge for those consultations, and we don't. We just want to help be just a resource for you in homeownership. And like I said, this is probably going to be one of the largest investments you make in your lifetime. So having a trusted mortgage advisor that can build a plan for you, I think, is a really important opportunity for you. And we want to be that consultant to help support you down that path towards homeownership. So with that said, we're wrapping up tonight's discussion, but we are going to stick around to do some Q&A. So if you had some questions that maybe didn't get answered tonight and want to kind of talk about that, we'd love to be able to stay on air with you. So we're going to go ahead and do that. And as a reminder, all the material for tonight, we're going to send out to you tomorrow morning. By the way, here's all of our workshops that we have coming up. We're going to have one for the Sacramento markets in a couple weeks. We're doing Riverside, Bay Area, and LA. It's going to be very similar, but if you do have friends, family, maybe some colleagues that want to join one of those classes, they're absolutely free. They don't have to necessarily be part of a partnership. And here's all my contact information too. So whether you want to just message me with a couple questions or schedule one of your intro calls or set up a consultation, we'd love to be able to get that connection with you. And I encourage you to follow on our social channels like Instagram. As I mentioned, as we're posting information about some of the upcoming products, I think it'd be great to be connected with us over the social channels. So that being said, I'll take a couple questions that are coming in. Question came in, what information should we prepare for a consultation? So we have a get started link that we'll send you. Typically for a consultation, you're going to do an online application. The online application is only a soft credit score. So that always is a question that comes up. So we just do a soft credit pull. We'll generally need the last 2 years of W-2s, your recent 30 days pay stubs, and your last 2 months of bank statements. Okay. Question came into, will this recording be included in the materials sent to us tomorrow? Answer is yes. And we post all of our workshops on YouTube too. So you can follow us on YouTube and you can see all of our previously recorded. I may look a little bit different, but most of the content is the same based upon the time of the year. And yeah, so, and that'll allow you can share that link with anybody. And okay. And thank you. That was very nice. Thank you for the compliment. I appreciate it. Yeah. Got a very nice comment from one of our audience members. So yeah, we enjoy sharing all this information. Again, if you have friends, family, coworkers that would love to check out this information, you know, we love bringing this content. We have our next class on September 21st. Hopefully you have friends that would like to join that. Okay. All right. I think we got all our questions answered. Well, thank you so much for joining tonight's class. I hope to see all of you soon for a consultation. Have a good night.